All right, let's talk about One Biopharmaceuticals. The company just had their big Q2 earnings call. And on the surface, things looked pretty good for their new drug, OJEMDA. But, well, the stock market had a very different opinion. So today, we're going to try and solve this puzzle.
And yeah, this is what I'm talking about. The day after they announced their earnings, the stock just cratered. It dropped nearly 16%. That's a huge move. And it left a lot of people wondering, what on earth just happened?
And that's really the core question, isn't it? I mean, they beat their earnings per share estimates, and their new drug is growing like crazy. So what gives? What spooked investors so badly? The answer, it turns out, is hiding in the details, in that gap between what looks good now and what the market expects for the future.
Okay, let's get right into it. We'll start with the main financial numbers, because this is really where the whole confusing story begins. So you can see the conflict right here. On one hand, you've got their earnings per share. They reported a loss of 29 cents a share, which was actually better than Wall Street was expecting. That's a beat. That's good news. But then you look at revenue, the total sales, and they came in just a bit shy, missing estimates by about 5.6%. And for a high-growth company like this, any miss on revenue, even a small one, can be a pretty big red flag for investors.
Now, you have to understand that revenue number is almost completely driven by one single product, their drug for pediatric brain tumors, OJEMDA. So really, if you want to understand the company, you have to understand how this drug launch is going. And if you just look at it from one quarter to the next, the story looks pretty good. OJEMDA brought in $33.6 million. That's up 10% from the first quarter. And for the first time, prescriptions went over 1,000. You know, if you look at that in a vacuum, that's a nice, solid performance for a drug that's only been on the market for a year. And if you zoom out and look at the year-over-year picture, wow, it's even more dramatic. Revenue is up an incredible 314% compared to this time last year. So let's be clear, this is not a failed launch. This thing is a rocket ship. But, and this is the important part, for investors, it's not about what you did yesterday. It's always about how fast you're going to go tomorrow. And this is where all that market anxiety really started to take shape. For the very first time, management gave guidance for what they expect OJEMDA sales to be for the entire year. They're projecting $140 to $150 million. Now, that implies huge growth, no doubt about it, but it also kind of suggests that the growth rate in the second half of the year might not be quite as explosive as some people were hoping for. And suddenly that guidance became the only thing anyone wanted to talk about. So this all sets up a classic tug of war, right? You've got the company's management team, who sounds super confident, versus the market, which, well, clearly had a very different reaction. Let's look at the two competing stories here. So if you listen to the CEO, Jeremy Bender, on the earnings call, he was crystal clear. He was talking about strong momentum and double-digit top-line revenue growth. He basically said the launch has gone even better than they expected internally. The message from management was simple. Everything is great. We're on track. And here you can see the two worlds colliding. While management is pointing to strong momentum, the market is just laser-focused on that small revenue miss. Management says double-digit growth, but investors hear, is that growth slowing down? And where management sees a really solid first-ever guidance, the market saw a number that was, well, it was fine, but maybe not amazing enough to justify where the stock was trading. So let's just boil it all down. Why the huge disconnect? It's because for a company like this, a biotech just starting to sell its first drug, the stock was priced for perfection. That means the valuation was assuming everything would go perfectly. So any tiny crack in that perfect growth story, like a little revenue miss or guidance that isn't a massive home run, it just creates a ton of uncertainty. The market isn't saying OJEMDA is a bad drug. It's asking if the future growth can really live up to that sky-high valuation. Okay, so that's the story of this past quarter. But what does this mean going forward? How do we build a thesis from here and think about the next earnings call? There are really three big things to keep on your radar. First, we're expecting more long-term data from their main clinical trial, FIREFLY-1, later this year. That's a big one. Second, another trial called FIREFLY-2 could potentially open up a much bigger market for the drug. And finally, you gotta keep an eye on their next drug in the pipeline, DAY301. It's what's called an antibody-drug conjugate, kind of like a smart bomb for cancer, and it could be really important for the company's future. So after digging through all of this, the strong launch, but also the market's concerns about valuation, we're landing on a rating of market perform for day one. So what does that actually mean?
Well, we think the stock is probably going to trade pretty much in line with other biotech companies for a while. On the plus side, you've got a fantastic drug in OJEMDA and a ton of cash in the bank, over $450 million. But that's balanced out by the fact that the stock is just super sensitive to growth expectations right now. This whole debate over whether growth can speed back up will probably keep the stock stuck in a range until we get that next big piece of news.
And with that in mind, here's a potential trade idea. Something a little wild, but plausible. You could establish a core long position just based on the company's cash and how well OJEMDA is actually doing. But to protect yourself, you could also buy some puts ahead of that big data release at the end of the year. Puts are options that pay off if the stock goes down. So it's basically a way to hedge your bet. It protects you against a potential drop, whether that's from disappointing data or just one of those classic sell the news reactions you see so often in biotech.
So there you have it. That's the puzzle of day one's recent quarter. A really strong drug launch colliding with some very, very high expectations. And of course, none of this is financial advice.